Good day. Thank you for joining me. I'm Ryan Kun, and I'm going to be taking you through AB InBev's interim 2019 results. AB InBev has a vast global scale which drives its ability to have strong cost advantage over its peers while allowing the group to mitigate country-specific risks for shareholders. Pricing power and market-leading brands translated into resilient financial performance in times of economic uncertainties, as reflected in its attractive operating margins and consistently good cash generation. The group has launched craft beers, flavor varieties, and hard seltzers to address slowing volumes, which could place brewery efficiencies at risk. This shift to niche categories is likely to prove essential to top-line growth going forward. All regions have shown organic revenue growth, with Middle Americas leading the way with organic volume growth of 6.4%, which translated into organic revenue growth of 9.8%. The group successfully launched its full portfolio in Mexico's largest chain store. The group continues its premiumization strategy as consumers continue to trade up, which allows the group's global brands to show strong growth outside of home markets. We believe AB InBev is a good quality company with a sustainable operating margin and strong cash conversion. Despite management believing the acquisitive growth and extraction of synergies from acquisitions is the core competency of the group, balance sheet flexibility will limit such growth. The company took on substantial debt during the acquisition of SAB towards the end of 2016. This resulted in the group rebasing the dividend policy and cutting dividends to support deleveraging efforts. The weaker liquidity position is evidenced by the net debt to EBITDA ratio of 4.58 times, which is significantly above the peer index. However, the successful completion and listing of Budweiser APAC has resulted in a capital injection which will enable the group to deleverage and bring its net debt to EBITDA ratio to below 4 times by full year 2019, a full year ahead of guidance. Due to the deleveraging initiatives, we expect short-term dividend growth to be modest, with strong cash conversion supporting the expectation of the dividend normalizing to historic levels subsequent to deleveraging efforts. Despite the short-term headwinds that the group is currently facing, we feel AB InBev holds value at current price levels. Currently, the share trades at a discount to its peers, trading on a forward P/E of 17.17 times, below its 5-year average of 20.21 times and long-term average of 21.4 times. As a result, we recommend an overweight position relative to the JSE Capital Index. Looking at a few financial highlights. Revenue decreased by 2% due to negative currency effects and hyperinflation in Argentina, while organic revenue increased by 6%, which was driven by global premiumization and revenue management initiatives. Gross profit decreased by 3%. This was driven by the increase in cost of sales due to currency and commodity headwinds throughout the period. Adjusted operating profit remained flat, while organic adjusted operating profit increased by 10%. The negative impact of lower revenue was negated by selling, general and administration costs increasing below inflation. Diluted adjusted earnings per share increased by 39% to 248 cents per share, and AB InBev's interim dividend remained at 80 € per share. If you would like to place a trade, please speak to your financial advisor or contact the trading desk. A comprehensive company analysis on AB InBev can be found on PSG Wealth's online trading platform. Before we end off, I would like to draw your attention to the disclaimer. Thank you.